2024 was a year marked by some of the biggest bankruptcies seen since the retail apocalypse began in 2017. This year, the number of store closings surpassed levels only witnessed before during the peak of the COVID-19 pandemic. The entire sector is currently facing some deep systemic issues as consumers change the way they shop and spend their money amid the rise of e-commerce and persistent inflationary pressures. While online retailers are experiencing a boom, many traditional brick-and-mortar brands are experiencing a financial collapse. Given that their rivals do not have to allocate such a big part of their budgets on physical operations, big box retailers are struggling with rising real estate costs, higher wages, expensive energy bills, employee shortages, as well as mounting debt, falling foot traffic, and weakening sales. Several companies are making incredibly difficult choices as they attempt to restructure and survive. Layoffs, store closings, and leadership shifts are just a few of them. In some cases, the only possible outcome is filing for bankruptcy. In fact, over the past 12 months, bankruptcy filings jumped by 16.8% in America, reaching nearly 453,000 cases, and that's up from 388,000 bankruptcy filings the year before, according to statistics published by the U.S. Courts Administrative Office. Most of them came from retail and food industry giants who owed millions of dollars to their creditors due to underperforming stores, costly leases, and failed business strategies. In this video, we compiled the top 15 bankruptcies in the retail industry of this year, including some companies that you probably didn't even notice went bust in recent months. Without further ado, let's investigate together what took some of the largest retail brands in the United States down in 2024. 1. Party City. For the second time in 2 years, Party City has filed for bankruptcy, but this time, America's biggest party retailer is liquidating all assets and shuttering its entire physical operation after almost 40 years in business. Just days before Christmas, the company announced that all 850 locations will permanently close after it ran out of money to keep doors open. Following decades of overexpansion, the pandemic led Party City to sharply reduce its brick-and-mortar footprint as lockdowns and movement restrictions were put into effect and prevented people from hosting parties and hosting gatherings for almost 1.5 years. The lost sales resulted in a Chapter 11 filing that aimed to restructure Party City's debt and to streamline operations. But in 2024, 2 years after it re-emerged from bankruptcy, the retailer continued to suffer with exceedingly low profit margins, declining sales, and stiff competition. Barry Litwin, the company's chief executive officer, said the company was doomed by stubbornly high inflation that sent costs soaring and deterred consumers from spending. It's really important for you to know that we've done everything possible that we could to try to avoid this outcome, Litwin stressed. He told his employees that Party City's very best efforts have not been enough to overcome its financial troubles. That is, without question, the most difficult message that I've ever had to deliver. Unfortunately, it's necessary to commence a wind-down process immediately. Unfortunately, many customers won't even have a chance to shop one last time at Party City stores due to its sudden collapse, but it's safe to say that the chain was a part of many people's cherished memories over the past 4 decades. 2. Big Lots. Even as more U.S. consumers look for deals and cheap prices amid the rampant cost of living, the discount retailer Big Lots hasn't been able to navigate through the current macroeconomic environment and went bankrupt during the third quarter. Since early 2022, the retailer has been reporting consecutive quarterly losses as profitability eroded due to rising inflation. With paper-thin profit margins and surging costs, many stores had been operating at a loss. Reduced spending on home and seasonal items among its core customers have only accelerated the company's demise in 2024. That's why it filed for court protection in search of a new buyer. In September, Nexus Capital showed interest in acquiring the retailer, but after a thorough evaluation of Big Lots' assets and Big Lots' financial condition, the sale was canceled this month. Now, the discount brand is going out of business and closing all of its 900 stores in the United States, effectively disappearing from the nation's retail landscape. 3. American Freight. Appliance and furniture chain American Freight went belly up in November after parent company Franchise Group filed for bankruptcy and decided to discontinue some of its brands to focus on others who have bigger growth potential. American Freight's warehouse-style stores were a place where U.S. consumers could buy everything from mattresses to coffee makers, but soon, loyal customers will no longer be able to visit those locations anymore because Franchise Group just announced the closure of all 341 American Freight stores in 41 states and the layoffs of all the chain's employees. 4. LL Flooring. LL Flooring, previously known as Lumber Liquidators, a popular home improvement company with more than 400 stores, was yet another victim of the retail apocalypse and the nationwide housing crisis. Just as many other brands in the segment, LL Flooring has been struggling to stay afloat since the health crisis because factors including cumulative inflation, rising mortgage rates, and declining existing home purchases have taken a toll on its business model. Rising debts and issues with suppliers have sent the company off a cliff this year as material prices have gone through the roof, while fewer Americans could afford to renovate their homes. In operation since 1993, the retailer used to serve communities in 47 states across the country. But as we head into 2025, LL Flooring will become just another brand to fade away into the horizon. 5. 99-cents only stores. Another discount retailer to bite the dust in 2024, 99 cents only. Persistent financial struggles that predated the pandemic have become too much for the company to bear, with liabilities and debts 10 times larger than its actual assets. The chain completely exhausted its funds to keep stores operational, but still, they weren't bringing enough cash in to stay profitable. During the bankruptcy proceedings, Dollar Tree bought 200 99-cents only stores to rebrand them into Dollar Tree locations. The remaining 200 stores are now being liquidated and will become offline by January 25th, according to the chain's website. 6. TGI Fridays. Consumers will certainly miss TGI Fridays' sizzling Jack Daniels-inspired dishes and signature cocktails as the casual dining chain closes doors for good before the end of 2024. A crumbling financial structure in a market filled with innovative competitors has compromised the company's long-term viability and contributed to its bankruptcy. On November the 2nd, the restaurant chain announced that none of its locations in America have survived the bankruptcy process. Only about 39 TGI Fridays stores operated by Hostmore in the United Kingdom will remain open in 2025. This means many American workers will lose their favorite happy hour spot, and families will no longer be able to celebrate milestones at their cozy local TGI Fridays restaurant in the year ahead. 7. Rubios Coastal Grill. Beloved fast casual dining chain Rubios Coastal Grill, known for its iconic fish tacos, salsas, and flavorful menus, has gone out of business due to a series of financial woes tied to declining sales, increased operational costs, and heavy debt. Parent company MRRC, hold company, filed for bankruptcy during the summer, citing difficulty to adapt to shifting consumer demand and elevated food and labor costs. That was the second bankruptcy filing since 2020. On the market since 1983, Rubios became a go-to spot for a quick, tasty meal that wasn't just affordable but incredibly fresh. Over time, that drastically changed, with customers frequently complaining about slow service and poor food quality. As rivals became stronger, Rubios has fallen behind. Its days are literally numbered. If you want to have a taste of Rubios' signature dishes for the last time, you can still visit one of the 8 locations still in operation in California. 8. Red Lobster. The Red Lobster bankruptcy was probably one of the most commented of the entire year. Internationally famous for its seafood-rich menu, the restaurant chain went under in 2024, leaving the public and industry analysts equally shocked. Apparently, offering all-you-can-eat shrimp is not a guarantee of success and good financial results when your underlying problems are not being addressed. While customers gorged on the shrimp promotion, they've shown little interest in consuming other items from the menu, which generated an $11 million quarterly loss for the chain. CEO Jonathan Tybus noted in the bankruptcy filing that Red Lobster ultimately sank due to a decade of failed or ill-advised strategic initiatives that continuously hurt earnings and resulted in a debt load of over $1 billion. Right now, the future of the brand is still at stake. Only time will tell whether or not Red Lobster will now be able to re-emerge and serve its customers for at least one more year. 9. Tiana Flats. Now that we're talking about high-profile bankruptcies in the restaurant sector, we can't forget about the Florida-based Tex-Mex chain Tiana Flats. Founded in 1995 in Winter Park, Tiana Flats gained popularity due to its bold flavors, overstuffed burritos, loaded nachos and chimichangas, and special combinations of spices. The chain filed for bankruptcy in the second quarter, declaring $1 million in assets and $50 million in liabilities, on top of another $19 million in debt. The company noted that its collapse followed a confluence of adverse events. In 2021 and 2022, previous management looked to increase revenue and profit by expanding menu options. However, the initiative did not have the desired effect. Additional options meant more equipment, staffing, and time to prepare, which led to slower food delivery times, higher costs, growing dissatisfaction among guests, and the eventual drop in sales. Profit margins were also squeezed by inflation and the fact that the chain introduced several price hikes over the past couple of years has only pushed even more customers away. Consequently, Tiana Flats closed operations in 11 states and is still trying to rebound under a new ownership. 10. Express. Apparel retailer Express, which also operates Bonobos and Up West, filed for Chapter 11 in the spring after years of facing declining sales and insurmountable challenges from other fast fashion giants. A joint venture led by WHP Global and 3 of the retailer's landlords, Simon Property Group, Brookfield Properties, and Centennial Real Estate, announced plans to acquire the company out of bankruptcy during the summer. At the time, Express CEO Tim Baxter said the brand's woes were solely related to broader shifts in the apparel sector. The woes at Express are not all of its own making. The formal and smart casual market for both men and women has softened over recent years because of a rise from working from home and the casualization of fashion, he said. This puts Express firmly on the wrong side of trends. But in a surprising turn of events, the Securities and Exchange Commission found that Baxter was taking advantage of nearly $1 million worth of C-suite perks, including certain expenses associated with the CEO's authorized use of chartered aircraft for personal purposes, even as the company struggled to stay afloat. Now, after being dismissed by potential buyers, Express is conducting out-of-business sales and shuttering its last 100 stores across the country. 11. Rue 21. Rue 21 used to be a mall staple all over America, but after going bankrupt for the third time in 2024, the clothing and apparel retailer seems to have reached the end of the line. Closures for all 543 Rue 21 locations are expected to be completed within the next 2 months, as reported by Retail Dive. Intense competition from online fashion brands like Shein and Temu have been crushing the American retailer, who recently suffered multi-million-dollar operational losses and difficulties raising capital in an amount sufficient to meet its liquidity needs and to fund operations. This winter, shoppers are making their final trips to Rue 21 stores. Next year, U.S. malls will look a whole lot emptier as even more brands shut their doors forever. 12. Joann. Another highly commented bankruptcy in 2024 was Joann's, the American arts and crafts retailer who has been in business for over 8 decades. With U.S. consumers cutting back on non-essential purchases as they adjust to the rising cost of living, retailers like Joann struggled with a precipitous decline in sales over the past couple of years. Even though the company managed to balance its finances and survive the pandemic, the losses that occurred since 2022 were so acute that Joann had to seek court protection to restructure its debt. Different from most companies on this list, Joann actually re-emerged from bankruptcy without closing hundreds of stores and laying off thousands of workers. While those steps were necessary to move away from underperforming markets, the chain's new owners have tried to preserve as many locations as they could until now. Though that isn't a guarantee that mass closings will not occur in 2025, it's certainly a positive development for the retailer. 13. Conn's Home Plus. For over a century, Conn's has been selling furniture and electronics for American households in 36 states. In July, the company filed for bankruptcy and announced that almost 400 stores would be permanently shut down by the end of the year. Just like others in the sector, Conn's faced a perfect storm of financial challenges, including cumulative inflation, underperforming same-store sales growth, and hardship in sourcing new supplies amid slower global production. In 2024, the company's revenue dropped 7.8% year over year to $1.2 billion, resulting in a net loss of nearly $77 million. Despite attempts to sell its assets, Conn's was unable to find a buyer, leading to the decision to cease operations entirely and to liquidate. 14. Barb Stores. Northeastern discount chain Barb Stores is leaving the market after serving communities for 7 decades. We regret that our financial position necessitated the liquidation of Barb Stores, Dave Barton, president of Barb Stores, said in a recent press release. Barb's has been a stalwart of our local communities for nearly 70 years, and we know our customers remember us as having been there for major moments in their lives. Barb's has half of its stores in Connecticut, with the remaining in Massachusetts, New Hampshire, New Jersey, New York, and Rhode Island. All locations are offering steep discounts on everything the company sells, ranging from shoes to clothing. Discounts span from 30% to 70% off, Bob said. That'll be shoppers' last opportunity to enjoy the company's deals. And 15. The Body Shop. Cosmetics retailer The Body Shop seems to be falling apart completely in all markets. In early 2024, it filed for Chapter 7 bankruptcy in the U.S. and Canada, liquidating its entire business and exiting the North American retail industry. Last month, it went bankrupt in the UK and the Netherlands, reporting similar issues, which include poor sales growth, falling foot traffic at stores, and unprofitability. In France and Germany, the chain also faced bankruptcy proceedings this year. Retail analysts are warning about the potential death of the brand, especially as celebrity beauty brands continue to grow and take a higher share of the market. The truth is that nothing is ever certain in retail. This is an industry that is constantly evolving and where everything is moving fast. A bad quarter can set off a domino effect of failures that could lead companies to a financial collapse. And with so many things going wrong in the U.S. economy right now, we should expect to see more big retail bankruptcies in the years ahead. What do you think? We look forward to reading your comments. Please subscribe to Epic Economist, and thank you very much for watching.